welcoming Mr. Atul Thakkar, Distinguished Director at Anand Rathi Financial Service Limited. With over 20 years of rich experience in the capital markets, Atul is a seasoned expert in investment banking and investment research. His specialization in sectors such as education, IT, and ITES brings a wealth of knowledge and insights to our gathering today. Mr. Atul will be conducting an enlightening masterclass on fundraising, transaction structures, and key terms. Let's give him a warm welcome as he takes the stage. Over to you, sir.
Thank you, everyone. Before we start with the slides, certain things that some of the learnings that we have done in terms of what most of the pitches come to us in terms of the education players when they want to raise money, especially startups. Uh, we have seen that at least 70% of the time they don't have clarity what they want, and that actually starts their they themselves starting to dig their grave. And if we as bankers are you know pressed with time and we don't do our own due diligence and sit with the company, then I think the plot is lost. Because uh, companies have to understand that when you go out to raise equity money, and I'm being very specific, equity money, the pool is very small, whether it is on the IPO side or on the private side or the strategic side. And everybody is constantly talking with everybody. Okay, how many ever NDAs you sign, it doesn't make sense. So if you are not successful in your first go, the second and the third round will be even more difficult to go to market. So you have to be very, very sure as to when you are going to the market, why you are going, with a very, very stated objective. There will be a lot of point in the conversations with investors where you will be far more desperate. But I think that's where you have to control, because if your banker has to help you control, because if you don't take care of that, uh, then you are in a soup. I'll give you two examples. First is that you know if your first round you are going to, let's say, assume are using at a 10 times revenue multiple, only because there is a euphoria in the market and your banker is willing to sell it and there is a desperate investor. Ultimately what will happen in the second round, either there will be some sort of an anti-dilution clause which will hit you, which if you are willingly ready to accept it, fair enough. If not, you will not get the second round or you will die, okay, as a company. It's very easy to see the headlines of various companies across sectors getting significant amount of money. I can tell you one thing, that the names that are getting reflected, at least 90% of equivalent companies are dying in the country, okay, and there are phases. So there is no data on that. Now whether you want to be in that 10% bucket or you want to be in the 90% bucket is what you have to take a choice at, okay. Yeah. So it is very important to understand what is the money required for at every stage, not just when you are doing IPO. When you are doing IPO, actually, the SEBI mandates it, what is the objects. But stages before that, companies just avoid what you are requiring the funds, and they will push the banker to the hilt and say, आप पहले investor लेके आओ, बाद में we will decide. It doesn't work that way. What is most important is that you do the meetings with investors when you don't need the money. You are always out in the market, understanding the ecosystem, and then you pick and choose based on what you need it. If you are raising money for a P&L item, for your OPEX, and you are diluting your equity, is this going to also add to your balance sheet? You have to look at it that way. If it is not and it is just an expense, okay, then which means that you will go to the market every time. And how long can you go? Is there a limit to it? Because if you are filling the working capital or your, M1, M2 losses through equity, you have only so much equity. How long can you survive? That is what you have to see. If you are doing for a capex, first of all, question yourself, is that a real capex which is required or not? 90% of the education companies come and tell us that content is the capex. And we clearly tell them that content is a sunk cost. It's not a capex. Please don't, go and dilute your equity for, beautifying your content. And we'll see a couple of examples. So you have to be very clear. What is your capex? What is the IP? And what is the amount that you want to raise for that? A couple of examples that I'll give you of businesses apart from education, which have grown, which have created category. Now, if you look at it, you have to be monotonous. Business has to be monotonous, predictable. Whether you take Asian Paints or you take Bisleri, they have built a category or they have built their businesses over decades. There are many startups across sectors who come to us and say, it's an exciting time right now in the market because everybody is raising money. I think it's a fearful time when everybody is raising money and everybody is going, helter-skelter in multiple areas which probably may not be relevant for them. And that's where you make mistake. I'll give you one example. There was a coaching company, listed coaching company, or a coaching company which became listed. And this is out in public, called as MT Educare. Okay, doing fantastically well in the Maharashtra and Gujarat state, and in fact having free cash flow to the extent of 50 to 60 crores and negative working capital. Okay, now that is when they tried to see that how should we deploy this cash and what all areas should we go into. In a matter of 6 months, they opened up into 3 different segments. They went into government contracts. They went into B2C vocational to a certain extent, again pseudo government with NSDC, and they went into EdTech, building content on the EdTech on the digital side with a product called as RoboMate. They spent more than 100 crores just in building the product. Okay. Whether the product is good, bad, ugly is immaterial. They could not generate even 5 crores revenue from that product. So that is what is very important, that how you take a call, whether your content is genuinely an IP or it is a sunk cost. Okay. And if it is a sunk cost, then how you start generating revenue from it. I'll give you another example of a company called as unlisted company based out of Bangalore called as Intellipat. Okay, for a 200-300 hour content, they will build content only for 5 to 10 hours. They will put it up on YouTube for free, and they will have a dedicated budget of some 10 lakhs odd to run it. If it is successful, then they will continue to build that content, and within 1 or maximum 2 batches, they will ensure that the content cost is recovered. So it is going to be on the go and not wait for it. Last week, I was sitting with a company. They said, government has mandated that all educationalists also now have to start doing, develop their enhancement and studies, etc. And there are many companies now which are coming into providing some sort of certification courses for teachers. And they said, we will take 6 months and 50 crores to build the content. And then post that, we'll go to the market. This is the worst thing to do. Because which simply means that you really don't know, after spending 50 crores, whether you are going to be able to generate even 1 crore or not. And for that 50 crores, they needed money from equity investors at a 200 crore valuation. So, just try and understand as to how you want to build your business, what is going to be your capex, what is going to be your opex, and also look at some other industries as to how they have operated. Now look at Asian Paints and Bisleri. Okay, there were competitors for both of them, but they have always had better margins than others, and they have not tried out anything, in just a euphoria, in sort of an exuberance, whatever their competitors have. What they have done is they have stuck to ensuring that the cost centers are on a consistent basis monitored, bettered, their costs are improved. Asian Paints provides delivery to their distributors three times a day. Okay, but the logistic cost versus just-in-time delivery, they could ensure that the distributor margins can be squeezed. So what works for you in your industry, you have to look at it. In your sub-segment, you have to look at it. There have been, when big boys like Pepsi and Coke came into bottled water, people felt that Bisleri will die. Okay, they are still existing, both the players are existing. So don't get afraid of some big boy coming into the market. When in fact Reliance came into education, everybody felt that, oh, they will sweep it. You have to understand what is your market, how this operates. Education per se as a market is not going to be a spray and pray market. It is not going to be a market where you have to be enamored by the TAM. Okay, it's a market which is a ground up market. You will have to keep on building it day by day, brick by brick. So, which is very important. Content is not the king. Best example is Navneet publication. They have probably an average or below average content, let me say. Okay. However, they have been quite successful in the target audience that they are. And they realize that they are into state board and their target audience does not want, fancy content. And since so many decades that they have been doing, okay, what they have mastered is distribution, reach out to the students, partnering with the schools, which others have not been able to. There is also a flip side of Navneet. The same Navneet has not been successful in EdTech, okay, because they felt that the same methodology can be utilized for the digital side of the content, and they use the same team. So when you are branching out, starting a new division, it is very important that as founders, you all think through what are the nuances which are going to be different for that segment, that division, and based on that, you add a proper team. There is a K-12 player called as Narayana Group, if you all know, okay, significantly large. What they are doing is replicating their asset-light school model pan-India. Now, and that is for a particular segment, which is aspirational class, going for JEE and NEET. They want to start with IB and IGCSE curriculum. But since 2 years, it's still on their drawing board because they are very clear that it cannot be done by the same team. You have to have a separate team. And they are just building the team right now. So now we'll go to this fundraising options. Okay. Equity and debt, there are two sides, and each category of paper is being offered by variety of investors. Which category of paper is appropriate enough for you at what stage is very important for the founders to actually understand and take a guided call. Okay. If we have to look at it, who are the players or the products which are offering you these category, and versus that, what is the cost as well as other strings that will get attached. that will give you a better understanding as to what should be done at what stage. uh, because and then you have to also keep in mind whether you are doing it for the, as I said, opex or the capex, whether it is for the long term or the short term. Okay. If it's a debt or from bank or NBFC, whether it is for your term loan or working capital, or a bill discounting, then probably the cost is significantly lower versus taking money from a private equity or raising money through IPO for that. Okay. You may get a longish tenure if it is a long term debt and you have given a security. If it is working capital, obviously it is meant for on a rotational basis, but it is not capital for growth. So what are you looking for? That is most important, whether it is capital for growth that you are looking for, or you are looking to solve your immediate problem of cash conversion cycle. uh, you will not be able to do any value unlocking in working capital, but you will be able to save your equity from getting diluted. Okay, and use it at an appropriate stage. Similarly, if you look at foreign bank or debt financing from foreign banks, people sometimes get astonished and shocked with the pricing that is offered, or for that matter, even venture debt, anywhere between 14 to 18% as the IRR, which is the ask. I would say it is far cheaper than in private equity. Okay, because at the end of the day, if you are preparing a very, very rosy picture about your business and you really believe that the cash flows in your business are going to come the way you believe it are going to, okay, then it's better off to take a debt and save your equity. Okay, and obviously the debt raised from a structured finance guy, the interest cost will also be beneficial for you from a tax break perspective versus what you are going to give to a private equity. So there are going to be strings attached at every stage. You have to decide where you are going to. Uh, they will, if your business is surrounded by some sort of regulations or has significant amount of structuring, then the the FPIs or the structured finance guy will definitely have a lot of say in that. They would want to understand, because at the end of the day, what is the security that you are giving over there? You are just pledging your shares and you are giving your cash flows, unlike a bank where they will need a hard collateral. Okay, so they will have some sort of a say, but ultimately I'll tell you, between the two, bank and the FPI debt, their interference or their input, whichever way you take, for you as founders in your business will be negligible, so long as their money is coming to them. Okay. The next two, which is private equity, venture capital, or strategic investment, okay, will on a contrary have a lot of say and a lot of discussion will happen in that board meeting. In fact, FPIs might take an observer seat versus a bank NBFC who don't take any management seat. Uh, Now, why a private equity will definitely have a lot of say in your uh, decision making is primarily because, to that extent, that they can even change the CEO or any other CXO level if they feel appropriate. And this is a ongoing saga of Byju's that is also happening. The simple reason, or for that matter has happened multiple times in West, is because at the end of the day they are your partners. So it is very important when you are at a juncture to decide whom to take your partner, and which Amit told you in the morning also. You should know as to two or three things. A, whether the partner understands your business or it is pure dumb money that is coming, because there is a lot of dumb money that is available, which may be colored and branded in a wide sense, but at the end of the day, does the GP who is sitting on the board on behalf of the fund really understand the business or not? If they don't understand the business and the business goes south, that is when you would look to, help from them. You will probably not get anything. And to that extent, I think a strategic investment would be far more better, okay, rather than taking dumb money from a private equity. And it all depends at what stage you are. Okay. 2 weeks ago, we got a pitch from a startup which was having 1 crore as revenue, 20% EBITDA margin. So from that perspective, good. Asking me for a 30 crore valuation, and showing a PPT where they are saying that the TAM and the business in 5 years can become 500 crores. My single question to them was, if the business can become 500 crores in 5 years and you really believe it, what is the reason that you want to sell it for 30 crores? Forget the valuation versus the revenue that you are asking. So be realistic in terms of what you are asking, from whom you are asking. The next point that they were asking is that they wanted money from a strategic. They didn't want to work with the strategic. Okay. So they completely wanted to cash out. Why would a strategic give you 30 crores for whatever is the size of the business when you want to cash out on day zero, when the business is not mature enough? So you have to go with some sort of right set of expectations and a right set of liabilities. Then only you should go to the market, otherwise don't. And this is an ongoing situation that we see. A month ago, we were sitting with, probably on the cap table of that company, there were 10 investors, and they have raised close to 400 crores from multiple investors, doing 150, 200 crore revenue, burning cash, asking a valuation of $1 billion. Okay, and showing us the TAM. My simple question to them was that you have raised so much money, why in the last 5 years you have not been able to? And again, they wanted money from the strategic. Okay, and they wanted to exit lock, stock and barrel. I can understand the investors asking for an exit. Forget the valuation. I'm saying for once, forget the valuation, but at least have some sort of rational conversation is what, as bankers, I'm sure my other peers also, and we always tell the founders that you need to have some sort of rationals. People come and tell us that I have spent 10 years, and they prepare a worksheet, Excel file, and show me that, my salary would have been this is the value that we have lost, and that's why we are asking. Don't compare those things. Nobody forced you to do it. You could have been in that, right?
That's the opportunity cost.
Yeah, agreed. It's fine. That's a call that you have taken, right? Right.
I haven't heard this. That's it for.
Sir, I'll tell you, we have seen such Excel files coming to our desk.
Not my direction. Absolutely. It's our opportunity cost. As a founder, you took a call.
Yeah. Yeah. IPO is nowadays, a lot of SME companies are also doing IPO, and it's become a flavor of the season. I'm always saying to all the founders that IPO is an event. What is important is how will life be after that event? Whether you get the money or not, and how much, at what valuation, all those things are separate. What will happen post that event? Are you ready as a company for that or not? And a lot of people come and say, oh, we have hired one of the big fours. We have a very good CFO. We have an entire corporate governance team. We have 2 independent directors, all those things. First comes, the business, and then everything else comes. Is your business sustainable enough to answer to public market investors on a quarterly basis. That is the most important thing. Even in a SME, are you ready to answer and publish your balance sheet on a half yearly basis and take the jolt if the numbers don't come? Because you are selling on the forward looking numbers, you are selling on a particular expectation. Are you able to achieve that or not is the most important thing. Okay, it's one thing to save equity and ensure that you have sold at the maximum value and you have got the cash on the table, whether for the business as primary or secondary at your home. But it is what is most important is that how will you take care of the business on an ongoing basis. And mind you, in all these three cases, whether it is private equity, strategic or IPO, one mistake and the markets are bad enough, they don't forget very fast. Okay, especially in the world where information is easily available. The next round, the next business that you intend to go, people will question you a lot. You will have to wait for a next generation to come as bankers, as advisors, and then probably try your chances to fool them again. And hence, it is always better to be conservative than try to uh, squeeze the last drop from your investors. Uh, at the same time, you should be very clear as to what duration and what tenure you want to have the money for. There are a lot of, and I have never found typically, or rather very rarely found promoters asking question to the investors as to what is the life cycle or of your fund, what is your fund life, okay, for how long can you stay. They only ask or discuss those questions when you reach at the documentation stage, which is too late. Ideally, you should be asking, okay, in the first or second round, worst case at the term sheet. Primarily because whether your business is aligned with their fund life or not, it is most important. In a strategic, probably you will not have those situations because there is no fund life. You have either sold them over a period of time, taking your earnouts, or it's an acqui-hire where you are part of the strategic. But in case of a private equity, in case of a structured debt, this is very important to ask. And that is where the conflict starts. Because you have given a particular projection for 3 to 5 years. Okay, your projections go amiss. Based on your projections, the investment was done. Now the GP is under pressure to sell and will tell you, to either ramp up some of the parameters which will be sellable according to him, may not be right according to your business. So your focus, your available cash flows will go into that direction. Now, and that's why it is very important that you take a call with your investors before the money comes in as to whether that investor is there for the duration of your business or not, or for a significant time till the time you can actually give them exit. And always plan to give them an exit before their term life gets over. I'll give you an example. We've raised almost 5 or 6 rounds of funding for Narayana Group. Okay, and they have faced other challenges on the PEP side also, and it is all out in the public. What is most important is that at every stage, if it is a 5-year paper, we have ensured that in year 3 or year 4, we give the exit to the investor. We don't want the investor to go out in the market, okay, in a situation of a desperation and selling the paper. So that planning has to happen. And in fact, we start conversations and roadshows on a non-deal basis for them, as early as 18 or 24 months into their investment. Because that tells who is actually keen for the story or not. When you are going to desperately need money and you are going to knock the door, Nobody is going to open it. But if your story is known to others and you have clearly said no on a consistent basis, that no, I don't need funds, there will be enough and more guys to come across. I'm happy to answer questions if there are any at any stage. Please stop me and ask questions. And this probably is a significant slide because it tells you about all the segments and all the types of paper that are available. So our suggestion always has been to our clients that you have to have a dedicated time on an annual basis that you are spending on roadshows or going to events, meeting investor sets, understanding from them, even though you don't need money, and always articulating it well and saying that we are here to understand and learn, but we don't need money, because it should not get construed otherwise, that they are always there in the market to raise money and they have not been able to close. At the same time, when investor sets ask you about your projections, please be ultra conservative. I have seen situations where everybody will say, my revenue is X, it is going to become 1.5x in the next 1 year because I'm expecting these 3 orders which are already 2x. And suddenly those 3 orders go vanish. And you are at X or probably at 0.8x. Okay. Just see a situation where you have put yourself in a spot 6 to 12 months down the line. The ability for the investor to actually believe you will reduce, whether you have raised money or not. Now, if you look at the type of papers that we had mentioned, okay, term loan and NCD are pretty straightforward, but the others, can you just pull this in? Yeah, pull this down. Yeah. But the others, if you see, especially, CCPS, CCD, OCD, warrants, safe notes, again, equity shares probably is a very straightforward, but the others have, a lot of meaning attached to it on the type and conversion that happens. Typically, private equity guys prefer a CCD or a CCPS because that gives them some sort of preferential rights on the board. Okay. And when you reach at a stage where you are negotiating with any sort of investor, I would suggest that please have a lawyer next to you who is good and understands the sector. Okay, it is very important that that lawyer has done some or the other work in the sector, because then they will be able to tell you what is the market practice, what are the nuances others have faced. Okay, a CCPS and a CCD gets converted either based on some sort of future value or some sort of future performance with some sort of minimum returns to the investor that they have expected, along with the rights package. Now, the rights package can include anything right from a single change in capital structure to removing the founders and changing the CEO, to having any sort of encumbrances or taking any loan. Uh, it will be a whole host of pointers that are there. Now, in most situations when things are good, you don't have a problem on all these things. But when it goes south, you have to really see how flexible has the investor been with their other investee companies. And it is always good to have a practice to go out, check out the investments done by the investor, reach out to their investee companies, understand as to whether the investor has been supportive enough or not. One best way to compare also two investors or the same investors, two investments, and negotiate with them is to just download their investee companies documents from MCA site. When you see whatever is filed with the MCA, that is the stated position of the investor. versus what they have given you and how better you can negotiate it and get it down. I mean, the investor will always tell you that, look, this is our standard practice, XYZ is required. If you remove their 5 documents of their 5 investee companies, you will automatically come to know as to what is the flexibility available in it. And 90% of the founders as well as bankers will not do this because they are always under tremendous pressure to close the deal. Okay, I'm not saying they don't know, but they don't do it and they don't compare or they don't negotiate it because there is a pressure to get the funds. And hence, timing it is very important. OCD is a unique paper because it also allows you to categorize it as debt. Okay. Now, whether it is at the choice of the investor or at your choice is very important. But let's also understand that if you are taking an OCD type of an investment, then and after that, even if your investor allows you to, probably the banks and the foreign FPIs who are providing you debt may not be comfortable. Because at the end of the day, the fundamental principle of debt is that, you know, you can have only so much exposure that is equivalent to a X percentage or X value of your equity, and that changes from sector to sector, and that of EBITDA. In education, largely what we have seen is that a debt to EBITDA of anywhere between 2 to 4 times. So if you have 4 rupees of debt, you should have at least 1 rupee of EBITDA is comfortable. Beyond that is generally not comfortable for the structured debt guys, and they will always categorize the OCD paper from a equity guy also in that way. And hence there is a new category of investors which have come, which are between the debt and the equity guy, called as hybrid funds. And these hybrid funds are actually issuing a lot of OCD, okay, where they ask for a minimum fixed return, okay, and then an upside sharing, okay, where they say we have to make a minimum of 15, 16 or 18%, and then if there is, if the business does good and we have to do a secondary sale, then overall return should be 20+% on the tenure. And this is all compounded returns that I'm saying, IRRs that I'm saying. But if you negotiate well, then these funds are open to, after a certain stage, share the upside with the founders. And when I say share the upside with the founders means they will say, okay, till 22%, minimum return is 18%, and from 18 to 22%, everything is mine. When I sell, if it goes beyond 22, then from 22 to 30%, I will share 50-50 with you. So the founder will get that much if the founder does very well. Beyond 30%, I will share 70% with you and 30% I will take, something of that sort. So those structures are available, and if you are confident that your business will do significantly well, then you can go for these exotic structures. But there is also a downside risk, that there is a minimum commitment on the return. So you have to try and have a situation that they don't go below their 18% or 17% threshold. Now that typically is not challengeable in the court of law, because it's a return expectation from the business. If the business doesn't give, you go bankrupt. Then there is a put on the promoter. Okay, if the promoter is not able to give from his own personal resources, again, the investor cannot squeeze the promoter out and get it. Having said that, a document which is negotiated in that fashion gives a room for the next incoming investor to negotiate harder with you for a better return. And you are in that cycle. So always the way you should see is that if at all you are raising multiple rounds, and I strongly advocate that to try and avoid raising multiple rounds, But if at all you are raising multiple rounds, and definitely not at the gap of 12 months and 18 months, then you should see that the next round money that you are raising should have far lesser restrictive covenants on you than the previous one. Because if your company has grown, if the valuation has been better and the investor believes in you and is giving you a better valuation, then the investor should also be more certain about the returns that they are going to get. And from that perspective, they should be far more, comfortable with the asset, and their terms should be far better. Okay. Unless you are a distressed asset. So if you have gone to your peak and you are going as a distressed asset, then it's a different thing. Okay. Warrants and safe notes. Warrants have been existent since long, and in fact are done by a lot of listed companies also. Warrants are typically given for by the promoter or by the investors at a particular price for conversion, where you can invest probably 25-30% right now and the balance later on. There, if it's in private, there may or may not be any financial covenant parameters to be achieved for the valuation. If it is in public, there is definitely no financial covenants. It is more a situation to stabilize the price and giving the promoters a chance to increase their stake in the listed company. And that gets converted into plain vanilla equity. Okay. Safe notes is something new which has come probably just before the pandemic. It's basically, having a floor and cap attached to a CCPS. Legally speaking, there is nothing like a safe note. So in your balance sheet, there will be nothing like a safe note that will come. It will be either a CCPS or a CCD. So it's a variation of a CCPS or CCD, where there is a floor and a cap attached with some additional parameters, and it is useful for startups where you cannot measure it directly in the financial parameters term. Like for example, if the company that I mentioned with 1 crore valuation, 1 crore revenue and 30 crore valuation, okay, if they are looking money from a financial investor, probably if the business is very good enough and the investor is convinced, may do something like a floor and a cap, and with some sort of parameters on the finance to be achieved, and that may get categorized as a safe note. Okay. And that is used very widely by startups, especially uh, when your revenue multiple or your profitability multiples don't get justified. Because on a 1 crore revenue, how will you justify a 30 crore valuation? Okay, your potential may be whatever, but that justification doesn't fall in place, and there is no real estate attached which you can value. So there is no other sum of parts done. Then you may do something with a floor and a cap. Uh, but I'll tell you one thing, that uh, at that stage, if you try to squeeze a lot your investor, as I started with it, you will end up later on either killing your company or having some or the other anti-dilutive clauses coming into it. The simpler way to do is have allocation of ESOPs, where management will also be able to participate. Okay. And a lot of unicorns have done that, and the management has been able to increase their stake. The other also way also to increase the stake is that, let's say you have raised money through venture capital or private equity, and the cash flows are generating then for the business. Then you take a small debt round in your private capacity, infuse it as primary in the company, and raise the value. And how will you repay the debt? You will repay the debt later on by IPO. But that, to a certain extent, is risky, and that is what Byju's did. He took a lot of debt also in the personal capacity, or by giving guarantee of personal assets, right? And today, when the business is going south, he has to probably pay it from his own pocket. The assumption at that time was that we will IPO someday. Now, if you don't IPO or you don't get a chance to do a secondary sale at a higher value, then you are in a soup. So that is a point of greed and fear. Yeah.
So Atul, when is it a good idea for a startup to raise debt?
See, if you are free cash flow generating, or for that matter,
What was the question? I missed that.
Is it a good idea for a startup to take debt?
Big debt. Sorry, go ahead.
yeah. So quantum is immaterial. If you are generating profit and it is getting stuck either into working capital, or you are generating free cash flow and you are looking money for growth, that is the time to raise debt. If you are bleeding, then you should not look at debt. You should, obviously, if you are bleeding on a consistent basis, you first need to introspect as to what is the reason for this burn. Is this a genuine, as I told you, IP or a capex that you are doing, or is this on the OPEX? And if on the OPEX side, if you are burning for a significant long period of time, probably there is a flaw in your business model, significant flaw in your business model.
Debt trap, actually, right?
Yeah. So, there are debt investors who invest in loss-making companies also, venture debt and structured debt guys. But if you are loss-making,
Amount of conviction that the cash flow need is temporary, because that one you definitely have to repay.
correct.
So you need high amount of conviction that you will have future cash flow generation.
Yes.
Many of the issues or high profile issues are happening because they thought they'll be able to get. On Excel, everything looks possible that you will have cash flows. Whether it is Educom projected that they'll get to 100 schools, or Byju's, which $1 billion of debt, or some acquisitions, or get over some, maybe all were thinking that IPO will become the liquidation event. IPOs are not certain.
Correct.
Next liquidation event is not certain. So that conviction has to come not from an external investor, but from your business.
Yes.
To be able to take that. And I think that's really important.
The guy who's giving you the debt, his question is also this:
We of them have perverse incentives to give you debt.
okay, but I'm just saying. By the way, NIIT started with a debt because there was no venture capital there.
Yeah.
Right, and at that time, I think the banker who banked on us at that time basically looked at us and said, "Business looks good." Nobody had done the business, so there was no there was no precedence to support. Just
But these bankers have first right on debt, right? If you might have pledged your assets and all. They have a first right, if you
On
go
your
for-
assets.
On your assets. So,
but we did not, and by the way, we did not give any personal
you're
security.
lucky. No, I'm not saying you're lucky.
Kamath looked into her eyes. And Mr. Bagul, I think.
But Mr. Vagul and Mr. Kamath, much later, I'm talking about Mr. Soni of Indian Overseas Bank.
He saw a presentation at Computer Society of India.
But sir, probably you have lived up to their expectation. If I recollect that time, yeah. But see, they would have also invested in multiple so-called, computer training program organizations at that time. Sir, you were the first one, but I'm saying post that, after your success, there were many which came into the
Now
market.
they will not touch this.
And they will not touch.
Large hole.
Correct.
Probably for them, they out of their total capital, maybe 0.2% or 0.1%.
It was very small.
But for a promoter, for a company, it is 100% of their. If it goes south, then probably.
See, at that time they gave us under the head of number one, institutional refinance. Right? Institutional refinance, because IDBI used to refinance. ICICI had not yet come in. IDBI used to do refinance. And this was for special schemes, growth schemes, which they had thought of. So he said, if you can get it refinanced from IDBI, then IOB is not taking a big risk, right? So you please go to IDBI. IDBI says, I can give you, provided you prove it to me, yours is a manufacturing unit.
And Vijay proved.
And I proved it to them, we are a manufacturer.
And explain how. I think it's important.
Yeah.
You have to be
Yeah,
creative.
yeah.
So,
No, you have to explain how. Shop floor.
fortunately, I had just learned at that time there is an input, there is a process, and there is an output.
I did not.
The CPU diagram. So I said, the input in this case is the person without skills.
The classroom is a factory.
The classroom, no. And by the way, computer was a very important element because there has to be plant and
Plant and machinery. It's the plant and machinery.
it has to be a plant and machinery. So the plant and machinery is that computer center.
Furniture, fixture.
Furniture, fixture, classroom, computer center. The output is a skilled student who has a marketable
Finished good.
Finish good.
The finished
Raw
good.
material, finished good.
Yeah.
Okay. Then he said, okay, I buy all that. But then you have to be in a factory premises. And we are sitting in Milton Court, Nariman Point. So I said, what is the definition of a factory premises? He says, A, you should have an electrical connection. I said, yes, that we have. Second, he says, you need 2 entrances and exits.
That is
Very
it.
surprisingly, we had 2 back-to-back
Small office.
offices. So one was one entrance because for fire safety, they need two. So the factory inspector came and approved. This is the factory. And this is without,
So this is just to say-
without exchange of any green, blue or any
Correct,
other
correct.
colored.
So,
note.
so the thing which we were saying is that bankers will look into your eyes. Remember that. We were saying customers will look into your eye. We're talking about first sale. How do we do? They will look into your eye. Because they're in the business of giving loans to people who will repay. Very simple.
That's how they make money, no?
That's how they make
Without
money.
that, they will not make money.
So then they will suggest, they will give
you
way
way
out
out
also. They will find you a way.
Yeah.
They'll find a way which protects
Correct.
most people. But life was easier then. Or more creative.
No, but I think for them, two issues.
But yeah,
One
you
is
started
you
with
should
that
have the
question.
security. Nowadays, they won't give you debt without
Yeah.
security. And second, as you said, you should have foreseeable cash flows. Your business should be
Unless you're confident that if this doesn't work, I'll do something else.
Yeah.
Which is one way to operate. But if this is what you want to do, then that can put you out of the game.
Yeah.
So this question is regarding the safe notes. And how does capping and flooring kind of justify the valuation to the investor? Like just
So I'll tell you, flooring protects the founder that it will not go below this, right? Capping protects the investor. You know,
this is with respect to the projections, right?
no, it's not with respect to the projections. It's with respect to the valuation. So let's say the company achieves the projections which are given in the model, okay, but suddenly there is a euphoria in the market, and a particular sector which was trading at, let's say, forward 3 times have suddenly gone to 10 times. If there is a cap, I as an investor will be protected to that extent. And let's say I have the same example. If I have achieved the Excel projections and the market is in a slumber and I have to convert it, if there is no floor, if all the others are trading at, let's say, 0.5x, then I have some sort of, comfort for the founder. So it's both ways. Okay.
They started safe, I guess.
Full form of safe. right? It's not safe. It is simple agreement for future equity.
Yeah.
Nothing safe about it.
Like it's what it is, it is going to, it's 7% gone essentially.
Yeah.
There's no thinking about floor cap, anything.
Now, how, typically, ideally, a steady state education segments are viewed by investors, okay, from their financials, whether it is profitability, free cash flow, and everything else on the balance sheet can be summed up with a ROE, ROCE, okay, whether it is asset heavy or asset light. So on the profitability, obviously given the regulated business, whether it is K-12 or higher education, has a business continuity, there is an annuity, okay, you will find it far more profitable. But at the same time, on the ROI, ROE, if it is asset heavy, even at its peak utilization, the ROI will be significantly low. Primarily because in their ROI calculation, the value of the asset and the value of the turnover, okay, at their peak also might not, the asset turnover ratio so called, will be maximum 1x. So whatever is their profitability, whatever is their EBITDA, it is immaterial. Your ROI will be at 20 or sub 20 if you look at it from the value of the marketable value of the asset. Okay. Asset light will be a little better, but in case of asset light, your margins will be significantly lower, okay, because you will have to pay your rents, etc. So it's a trade-off that you will have to take. Higher education also equivalent. Test prep, the profitability will be significantly high, free cash flow will be good enough, but the life of test prep business is very short-lived. Okay, there they grow significantly fast and then they die out, because in most test prep business, at least historically what we have seen, there is a star teacher led situation, or they are dependent on one or two courses, and every year you will have to have 30, 40 or 50% new enrollments required. Okay, now if the product is not the hero and an individual is a hero, then it makes life hell. Okay, and there are many such players who have come and who have got wiped off. So test prep or tuition, that's a very tricky business, and there was a time in the last 15 years, for 2 to 3 years, all investors were very, very keen at the test prep business, primarily because there was significant free cash flow, okay, and profitability. Also, at the same time, they would say there are no regulatory or structural issues. I would say the other way around. Everybody has money, okay, but they don't have the patience to deal with the regulators and try and take care of all the regulatory norms, and hence there is no competition or limited competition, let me put it that way, in K-12. Otherwise, what stops from everybody to open up schools and see equivalent competition that you are seeing in tuition? And if you see, the comparison that parents do with regards to test prep is that who is the teacher who is going to teach, and whether the teacher is going to teach is a good quality teacher or not. And when you are going to go to the test prep institute only for a 18 to 24 months or max 36 months. In case of school, when you are going to put your kid for a period of 10 to 12 years, you are actually not concerned with what is the quality of teachers, or you don't even know the names of half of the teachers. You are more concerned if what facilities are given, what is the infra, what is the social structure. So it's a complete different thought process that with which parents are going. Vocational as a business, why, if you look at it, that's one business which has been neutral if you are a consistent player. Again, in this business, people come, people go. But if you are consistent, then you will be able to generate your alpha in terms of your ROIs, be able to, utilize it appropriately, do brand extensions over a period of time. If you don't, uh, you know, get overexcited with the TAM and say that I will launch 20 courses overnight, okay, build brick by brick, then this is one area that you can do. I mean, I was during the lunchtime talking with a couple of guys. If you do a product fitment where the same course can be sold to multiple channels, whether it is B2B, B2C, or to corporates, etc., then this is one segment where you will not see probably the 40-50% margin which the K-12 guy sees, or what the tuition guys see in terms of the free cash flows, but there will be a steady growth. Further, I've always seen that people coming across and saying that in the next 3 years or in the next 5 years, if today I am 10 crores, I want to become 500 crores. What is the hurry? Is that the hurry that you as founders have? Yeah. Is that the hurry that you as founders really have it? Or is that the push coming from your investors? And that is the reason, again, to decide on the patient capital. A growth rate, and Kapil and I were discussing, Kapil was mentioning about only 10% growth rate, if compounded, how it can give you. But I'm saying a steady state growth rate of a 20-25% on a continuous basis. If you are keen to run the business and if you are passionate enough, I don't see a reason why you should be, looking at flipping the business in 5 years. So if you are really keen on the business to continue over a long duration of time, a steady state 20 or 25% growth rate compounded year on year is a very, very, very good business. It's a rock solid business. That is the multiplier. If you do it on Excel, you will get a phenomenal number. But, 90% of the founders don't walk the talk. At one end, they come and tell us, we are very passionate about the business. At the other end, they say, अरे 5 साल में इसको बेच देना है. So, which means your passion is going to be only for 5 years.
Can you give some successful names in that segment? Okay. Yes.
You are sitting in one of them. You are sitting in one of them, right?
From NIIT.
See, if you look at globally, there may be few names. In India, AppTech, till the time their CEO was alive, was doing good. Okay. Post that, they lost the plot. And when they got sold to an investor, when most businesses get sold to an investor, okay, that is when probably you have to be very careful whether it is being given to a right investor or not. Okay. In terms of small scale, there will be many players which will be regional. Okay. They did not have the vision or they didn't want to grow it big. Publication, again, this has been a... Yeah.
So, while the slide is very intuitive, but if you look at the market scenario, it's completely counterintuitive, right? Because we all know test prep is a very short-lived sort of, it will go in its cycles after that. But if you go across all the VCs and all the private money which is going into education or EdTech, a mountain of it goes into test prep. And which we can all argue how much value is adding it to the society, But the other sections which are genuinely adding don't get it. So I'm not sure. I would even question how the investors are thinking, right? Because see, it's very easy for an investor to turn around to a founder and say, think long term, think sustainable, think do this, do that. But if you are flipping over to me and saying, I will not put value to your business because I'm still in the business of flipping, but you don't flip.
That's where you are going to the wrong set of investors, which is where I said you have to ask the investor what is his duration, what is his fund life. is he putting as a GP a percentage of the fund is coming from his own personal pocket or not? There are quite a few new funds or even some of the old funds who have started a practice where compulsory the GP partners have to put in a percentage of the fund from their own pocket. Okay, that's first. Second, as far as you are right that most investors are looking at test prep as a business to invest because again they are going by the TAM, okay, which is tangibly defined, whether it is for NEET, JEE or some of the central state examinations, etc. Okay, and they are playing on the greed and fear of the child as to how this particular institute will be able to position or not where they are investing into. Okay, but if you see how many investors have got exit over there, not even 10% of the value has come out as exit. We had done a report in 2013, I'll share with you. Not even 10% of the invested value of investors in Toto has been exited. So that is the reason now why some of the test prep investors are open to looking at K-12 and higher education. Previously, they were always saying that K-12 and higher education, there are significant regulatory challenges. We don't want to look at it. We really don't know whether this will go, our investment, whether we'll be able to recover our cash flow or not. And you look at it, Upgrad is invested into a higher education company, right? Into a university. They will not be able to do it without the nod of their board, which includes GIC, right? GIC themselves have invested into Narayana, which is a K-12 player, right? Your physics wala is moved into both degree as well as into K-12, right? Allen is now going into both degree as well as K-12. Okay, and the guys who have lost money, investors of KKR, investors of Resonance, KKR. I mean, look at the quantum that they have lost. And after that, so that was the debt side of KKR. After that, they made an investment into Lighthouse Learning, which is pure K-12. Eurokids, which is now changed to Lighthouse Learning, right? So I'm saying it will happen, it will take time because some of the decisions that the GPs are taking over here are also as per the guidance of their IC, which is sitting outside. And the IC sitting outside doesn't know the domestic phenomenon.
I mean, it's understandable. They're chasing alpha. That's why they're doing it. Completely understand.
And that is where they also see that if I'm investing in test prep, probably I can flip it in 3 years. Like I'll give you Resonance investment was done by CLSA and one more other fund. Okay. They could have easily done an IPO. The greed of founders and investors killed it. Because the investors and founders wanted that the IPO happens at 20 times EBITDA multiple only. No banker was ready to take that mandate. And they wanted at 20 times because CLSA and the other investor had invested at that particular multiple. So they didn't want to have their EBITDA multiple going down. Founders were not open for diluting their stake and giving as per the anti-dilutive clause to the investors. Otherwise, they could have easily done an IPO. They took debt. They also did some other, creativity around university, buying land, etc. They lost the plot.
This is what year? This is what year?
This is 2016 to 2019, way before the pandemic.
Would you consider Narayana only under K-12 or would you also say it's test prep morphed K-12?
So they, as a business, they have evolved. Okay, Narayana was started as test prep. Then they started actually higher education. They have a medical college, full-fledged medical college with 1700 bed hospital. Okay, they have MBA, they have engineering. Then they realize that higher education, I'm finding it difficult to grow and it is very capex heavy. So they moved to K-12. This is 2002 odd, and they were till 6th standard. They 2012 they moved outside of AP Telangana and they moved from KG to 12th. Okay, in 2012, out of 150,000 students, they had in schooling around 10,000 students. Today, out of 500,000 students, they have 250,000 students in K to 10 or more than that. Okay, and out of 10th, whatever 15-20,000 students are coming out every year, not even 50% of the students are applying for NEET or JEE in 12th. Forget about joining Narayana. And their coaching side, they have got only 15,000 students, which are standalone coaching in NCR and few other places.
Who's bigger now, Chaitanya or Narayana?
Chaitanya. Any questions? I think the time is up. Okay, any questions?
Yeah, so after the movement of Byju's out of this segment, slowly they are. So do you think that there is a chance that somebody else will be rising over there?
It's a cycle. Every 5 years or 7 years, you will see, someone becoming a hero and then probably stagnating. So it all depends as to what segment you are looking at it. Today, if you see, there are 4 or 5 large players in the test prep or allied segment addressing to the same market. Physics wala, Alan, Chaitanya, Narayana. Okay. And then the 5th will be probably motion somewhere in Kota, etc. Kota as a market is gone out. Unacademy and Vedantu might just catch up sometime. Okay. But whether these 5, one of them will become a hero or somebody else, don't know. Akash, whether it will come back again, bounce back or not, it all depends what happens on the board and how the cap table happens. If Akash is able to move out, it's a very strong brand. So those cycle will keep happening. What is most important is that it is all these players, unlike physics wala, okay, there is a lot of UN cry that is there, but all the other players have built over the last 3 to 4 decades. And then expecting that, we as startups with whatever size, shape and form will be able to do it in 3 to 4 years and putting it up on an Excel is not right. Just because there is a TAM which is significantly unaddressable, etc., etc.
On this table, this is Ashish. Skilling, upskilling, which is more towards going to employability nowadays, because still country less than 50%. Where you put them?
So they will come under the vocational plus higher education. So yeah, why vocational plus higher education is that if you are providing some thappa, then it will be higher education, otherwise vocational. Your price will increase to that extent.
I have one question. In terms of, there was a euphoria about EdTech for a while, then that died down. Now, a couple of questions in that theme itself. When the euphoria came, what did the investors see in the long term that they had that euphoria? Because they are always thinking long term for that matter. And now that it has died down, what is the general sentiment that, say, the market or the investors are having about EdTech and how do they view it? I know there's a course correction that's happened, but something that maybe this forum might not know as to how investors are looking at edtechs now.
So I'll tell you, first of all, edtechs should not look at themselves and distinguish and tell we are edtech. It's simple. Call yourself as education group, education company. Okay. The only reason that tag of a tail of tech was attached was for valuation. Okay. Now, the euphoria has settled down. Everybody knows what the valuation is, where it to be. And that euphoria was not just for edtech. It was a tech euphoria. And the same 5 to 7 years, you saw e-commerce growing, you saw health tech growing, you saw fintech growing. Okay. So there were multiple sectors which grew with a tail of tech, and they got their valuation, which was whatever they got it at that time. Now everything is come back to normalcy, saying cash flow is the king. Okay, irrespective of what sector you are. So I am saying that the investors at that time, are also under pressure from their ICs at times to take certain calls. Okay, because it was a global phenomenon. Money was also available to the investors at a significant cheap rate. So there was arbitrage available. There is also whatever you call it, FOMO. Okay, there is now a realization, and these cycles will keep coming and going. There was a cycle between 2005-7. There was a cycle in 99-2000. You had this pandemic cycle.
How the investors, the current set of investors, are really looking at the new set of technologies? Are they really prepared to ride on these particular Gen AI and all those particular set of fancy things which are happening?
See, in 2010 and 12, between that time, and probably, NIIT was still having their software company, so they will be able to tell you much better. There was a euphoria around, buzzwords like cloud computing, okay, and big data, etc. Now, what has happened? Every company is doing some sort of analytics, but the word big data is moved out, right? This is right now, we believe that it is a phase of Gen AI, etc. Okay, then it will get ingrained into. Does that really mean? And I think we were discussing during lunch with someone that, people are also questioning कि investment banking की दुकान बंद हो जाएगी. Okay, there are a lot of people who are saying, and I'm saying yes. What will happen is, whatever is the mundane stuff, okay, whatever is the analytics, whatever are the predictions, whether the founder is giving you the right set of numbers or not, probably that you will be able to get it through the AI tools. And it will be, at the end of the day, tools. The decision making, the negotiation skill sets will still lie with humans, whether they are the founders, investors, or bankers. So it will slowly and gradually come into the system. Okay, it will have its own peak and then settle somewhere.
So right now it's at peak or it's picking up?
That all depends. What is the valuation and the check size that you get, right?
I think if you knew that, he'd have his own island.
All right.
Right?
Okay.
Thank you.
Very good. Thanks. Very engaging session. Thank you.